Hey everybody, welcome to Young Bucks. As you can see, we're very much a work in progress, but we're glad you made it here. Today we're going to be talking about a couple things. We're going to talk about Tesla's attempt to take over the auto world. We're going to talk about really awful financial decisions made by a former NFL athlete. And last but not least, we're going to show you how to make the world's worst cocktail. Stick around. Hey everybody, welcome to What the Buck, the weekly segment when we take a look at major money-related headlines. Let's just jump right in. First things first, especially relevant for this show, Young Bucks. Welcome to the party, young people who are investing for the first time. According to E-Trade, 31% of investors between the age of 25 and 34 are looking into taking on new investments. That means they're finally starting to put a little bit of cash to work. Ben, first questions first. Is this a good time to be entering the market from an investing standpoint?
I think it makes a lot of sense because people do have a lot more money in their pockets. It is also not a very surprising statistic because 31% is not very many for a bull market, and that's 9 years old. Plus, millennials tend to be a pretty risk-averse generation, and so you have that playing into it as well. I would like to see a comparison between that and what the baby boomers are thinking about investing over the next 6 months.
Yeah, interesting point. UBS had some research, and Ben actually tracked this down, but I stole it from him. The average investor between the ages of 21 and 36 has 52% of their savings in cash, which is quite a bit. Krebs, Ben makes a good point about the market being up. Year 9 of that, up quite a bit, halfway point of this year. Would you encourage young people to start investing now, or would you wait for a pullback?
I mean, it makes sense, like intuitively, like you have this excess money now. You have, let's say millions are having more money at their disposal. So it makes sense that they want to invest, but I view it as a contra signal, I guess.
Honestly, that's kind of what I was thinking. Is like it makes sense if you're in that age group to get invested. The sooner the better. And just have that money in there. You're gonna have some ups and downs. You're gonna time the market well sometimes you're not. Just dollar cost average, get that money invested. Yep. In terms of like trying to time the market, I think everyone's tried to time the market before, and more times than not, you fail.
Yep.
And so in terms of trying to say, well, I'm waiting for a pullback and then I'm going to put my money in, you could miss, 10% upside and then before it pulls back, or worse, 20% upside before it pulls back. That has a meaningful pullback.
Yeah, I think the interesting thing is kind of to read through both on investor confidence as well as consumer confidence, because there's something to be said with people who maybe came out of the college ranks in 08, 9, 10, 11, even 12, having trouble getting a job and feeling like, hey, I need to save everything, I need to have quick liquidity, all that kind of stuff, versus now maybe feeling a little more comfortable, like, hey, my job's pretty stable, the savings going away, feel good about the economy, let's get this money to work for me. Speaking of going to work, Tesla's going to work. How about that segue? It had nothing to do with work. Krebs, talk to us about the Model 3, and is this the breakthrough everybody's been waiting on, especially from an investing standpoint, for Tesla?
Yeah, so the Model 3, Tesla's Model 3 is finally coming off the production line recently. And the first models have been going to like employees and hire people at Tesla, but we have the basic specs now of what the Model 3 is cost-wise. So the bare bones model of the Model 3 goes for $35,000, which is okay. That's pretty cheap. That's what they've been publicizing for like the more affordable electric car. So that has a mileage range of 220 miles, which is okay. But what they don't tell you is that to get like all the other things added onto it, like autopilot, which Tesla is known for, to get an upgraded sound system, which I would of course have, because and heated seats, higher grade materials. I don't really know what that means, but let's say a nicer car, that'll cost you at least an additional $25,000 on top of that.
So you get to 60 real quick.
Yeah, so basically you want a souped up Model 3, it's $60,000. I mean, compared to a Model S, which is the sedan, not the cheaper one, but that's like $80,000-$90,000 too.
The biggest question for Tesla is going to be, they're about to find out, do people actually want an electric vehicle or not?
So
here first.
So no takers on the Model 3 yet from us. Krebs, we're going to talk sports a little bit. We got a whole segment on great things that athletes do with money coming up in just a little bit. But one thing we know they like is cars. Just touched on that. They also like big contracts. Let's talk NBA deals.
So this summer there's a lot of contract expiring in the NBA. So a lot of people are signing contracts, and pretty big ones, because the salary cap has been going higher and higher the past couple years. So there's more money to go around. So just for some background for some big deals of some good players in various leagues. LeBron James, the GOAT,
No, second go, next to Kobe.
Is currently under a 3-year deal for $100 million, player option in the 3rd year. Derek Carr just signed, who plays for the Oakland Raiders in the NFL, just signed a 5-year deal for $125. And Giancarlo Stanton, the outfielder for the Miami Marlins, signed this in 2014, 13 years, $325 million.
That's fake news. Baseball contracts are fake news.
that's our baseline right there. All right, so first one, Steph Curry, 5-year, $201 million. That's about $40 million a year. What do you guys think about that one? Good deal, bad deal?
Good deal, especially where that team's located, as successful as they are. I mean, they got to be bleeding money in a good way.
Ben, you're a big NBA guy. What do you think?
Good deal.
Yeah.
I got a good deal.
Big fan of Steph Curry around here, huh?
Yeah.
It's $40 million a year for.
Full disclosure, I'm just going to jump on the consensus view for all of these.
All right, you're going to push first for this one. Paul Millsap, Atlanta Pride and Joy, 3-year, $90 million.
Stupid.
With the Nuggets, this is.
I'm going bad deal.
He opted out of the final year with the Hawks for $21 million, so that's $30 million a year, 3 years.
I think it's a bad deal. I think Paul Millsap's a very solid role player. If he is your all-star off your team's not very good.
He averaged over 18 a game last year.
Yeah, if he's scoring 18 points a game for your team's not very good. And that's coming from a guy that lives in Atlanta and roots for the Hawks. So that's a bad deal. I thought he was overpaid at 21. I mean, he's just a solid role player. He should be your 4th best player.
Bad deal, classic Hawks player.
James Harden, 4-year, $228 million, $57 million a year.
Here's what I'll say
Arguably
about
an MVP, keep that in mind.
Arguably, not a big fan personally. The beard is like way overdone. You can't give a guy $228 million if his jersey has been retired at a strip club. And his jersey has been retired at a strip club in
I bet
Houston.
you can't say that.
You are You are asking to have $228 million burned. Bad deal.
I don't think I'm a fan of it. I'm just going to leave it at that.
Bad deal. I mean, if he's getting paid 1.5 times more than Steph Curry, there's something wrong.
That's our only good deal, Steph Curry.
That just feels strong for James Harden.
Real strong.
I don't know.
It's a lot of money. All right, last topic we got the Mooch. The Mooch is out. He had like a 6 or 7 day run at his White House.
Was he even officially?
Not even official. I think his official start date, according to the real contractor government documentation, whatever they call it, is August 15th. Didn't make it. So in a 10-day period, he gets the job, basically leaving the press. He has a baby. He doesn't show up for the baby's birth. He texts his wife, "I will pray for our child." There's rumors that his wife is leaving him. He talks crap about Rance Priebus, who was chief of staff. Rance doesn't respond, and that's part of why he is fired by Trump. New chief of staff comes in, gets rid of Mooch. Where do we go from here if you're the Trump White House?
Well, I think that Scaramucci wasn't fired because he was never actually started, so that's number one.
He was fake news.
Yeah. Number 2 is I think that Trump is just trying to defer all management control, and the problem is he's got people in there who aren't really the best people. And he needs the best people in there, and he's not got them yet.
The best part of this, I think, if you're Trump, is that Jared Kushner had the quote that came out earlier this week where he told a group of interns that the Trump campaign did not collude with Russia because the campaign was so disorganized and incompetent. And we're seeing continued disorganization. So it looks like we're going to get this Trump-Russia thing behind us once and for all.
Indeed.
Thanks to the Mooch. That's all we got. Stay tuned. Lots of content coming your way. So, Scotty, there's 2 things that I really love to do. 2 great passions in life. Number 1 is talking to people about money and investing. That's why we do this little show here.
Absolutely.
And number 2 is drinking. Big fan of drinking. So, what we're going to do today is we're going to talk about asset allocation and what it means to have a balanced portfolio. And to do that, we're going to use our friends over there. We're going to be guided by these spirits, if you will.
Ooh, I like that.
So, what we're going to do, a little comparison between each asset class and a liquid. So, first things first, water. Now, we don't have any water out here because we're trying to drink, not hydrate, but water is a very important component of an investment portfolio. It gives you a lot of liquidity.
Oh, that's a good one.
See what I did there? It gives you a lot of liquidity. You're able to move in and out of other asset classes if you have water. I mean, you hear all these silly rules about, beer before liquor, never been sicker, liquor before beer, in the clear. None of that really matters if you have the right amount of water.
That's right.
If you hydrate yourself both before, during, and after a night of drinking, you're going to be fine. Similarly, if you keep some cash, when the market's going like this, you're able to move in and out of it with a little bit more ease. So water is a really important thing. So water is your cash in your portfolio. I highly recommend having a little bit of cash. Next thing we're going to talk about, why don't you open up a bottle of wine for us here?
Absolutely.
I'm going to talk about some wine. I'll slide you a glass over.
Appreciate that. We got some real fancy stuff in here today. Some 14 hands, 2015 cab.
Ooh, I'm just disappointed that it's not a screw top. Nonetheless,
we had to class it up a little bit.
Wine, you used the right word there, class. Wine is the classiest of the asset classes. It is your bonds. Now, when you think about bonds and people that have a lot of bonds in their portfolio, you probably think about older people. They got a little maturity to them, a little bit of sophistication to them. Bonds are a really important part of a portfolio if you want it to be truly balanced. Now, for young people out there, you probably don't need a whole lot of bonds. Millennials do drink a lot of wine. I've seen all the data. But at the same time, are they drinking more wine than they're drinking beer or other things? Probably not. So it makes good sense to have some bonds in your portfolio that does a couple things. Number one, it limits the volatility. With a good wine, you kind of know what you're getting. And that's the same idea with fixed income. We call fixed income, which is the broader class that bonds fall into. We call it fixed income because it's doing exactly that. It's giving you a fixed amount of income. So when you think about a good bond or when you think about a good wine, the things you're thinking about are, well, hey, what's on the label? Who's issuing this wine? Is it a good vineyard? Is it a good corporation or municipality issuing this bond? Does it make sense? Do I believe that they're going to put out a good product? For wine, we're talking flavor, savorability, the airiness, the fruitiness, all those rich words, the chocolateness. Chocolateness is really important. You don't think about chocolateness on bonds, but you are thinking, hey, are they going to actually make good on what they say they're going to do? Are they going to pay me that amount of income? So you think about stuff like that. You also think about years. Years get really important. A 2015 cab may drink totally different than a 2008 cab. At least that's what I'm told.
Absolutely.
I can't really tell, but that supposedly happens. Also really matters that you pay attention to the years, the maturities, and the call dates on a bond. So what you're getting as an investment vehicle on something that maybe gets basically expired, it actually matures or gets called in 2 years, a 2-year term versus a 30-year term, it's going to be really different. So, to wine and to bonds.
Delicious.
That's a corporate bond, you can tell. You can really tell.
Without a doubt.
Bonds make good sense in a portfolio. A great rule of thumb that I don't wholeheartedly endorse, but I think it's pretty clever, is however many years old you are, that's the percentage of your portfolio that should be in fixed income. Now, I think even that's a little bit conservative. If you're 30 years old, 30% in fixed income is a lot, but understand what it's there for. It's going to generate you some income, limit volatility from things like the stock market. Speaking of, let's grab that big old ice house over there.
Hey now, 40 time. Can't beat this stuff.
As we transition, we're going to get slightly more aggressive on the investing scale. Now, obviously, a bond can be really aggressive. We've heard of things like junk bonds. That's a risky choice, kind of like drinking wine out of a box. Not necessarily always going to pay off, but that's something you got to kind of keep in mind. Beer, as we get a little bit more aggressive, these are your equities. The more common term for equities are stocks. So, got that ice house, not only a 40, it's a 42. Plastic bottle.
We don't go small here.
Tastes like college. Here's the thing with beer. It's going to be your equity class for a couple reasons. Number one, you kind of know what you're getting, but you also have two schools of thought. Now, you have one school of thought that says, you know what? I'm a value stock investor. I like to find companies that are undervalued. What that means is if the company's worth $100 in your opinion, but it's trading at 80, you'll buy it with the hope that it gets back to 100. So that's going to be one school of thought. The other school of thought is let me go after something that's growth oriented. I expect this to really take off. It's trading at $80. It's probably only worth 40, but I think at some point it could be worth 200. So a little bit more speculative. You also have kind of delineations between large cap, which is basically how big is the capitalization, which is a fancy word for how big is this company. Really big company like Apple are going to move a little bit less. They're a little bit more stable. They're a little bit more predictable. Some would say they're a little bit less sexy. So Ice House, a little bit less sexy. Why don't you pop up on something else for us?
Absolutely. Here we got some Ballast Point. Big fan of this stuff. An IPA.
Now we're talking. So, if Ice House and your generally cheaper, lighter beers, your Bud Light, Coors Light, Natty Light, office favorite, your Kirkland Light from Costco, if those are kind of your large cap value stocks, predictable, you need a lot of them to really make a move, your microbreweries are going to be more your small cap stuff. Mm-hmm. It's a little bit of a risk, especially in the microbrewery space now, because there's so many names out there, right? You go to a liquor store and you're like, I've never even heard of this, but the packaging is really cool. I guess I'll try it. Maybe it's really good. Maybe it pans out. Similarly with small cap companies, that's kind of the challenge. I'm not suggesting that you roll a dice. You should think much more seriously when buying a stock than when buying a six-pack. But kind of the same concept. The upside's really high. The downside's also a little bit steeper. So, Ballast Point. Cheers. Cheers.
Big fan of that stuff. Delicious.
That's really good. Mm-hmm. So that's kind of the difference between a value and a growth stock, or also a large cap and a small cap company. You also have all kinds of intricacies when you start to talk about investing, especially on the equity side. I mean, you have international stocks, you have all that stuff. It still applies to beer. You can drink international beer, a lot of people are saying. So I prefer to drink American, but you can drink anything.
Absolutely.
You can also invest in just about anything. Have a great idea. You can probably find it on the equity market. So, one thing you want to do when you're looking at an equity portfolio, which again is your stocks, you want to make sure you're diversified. A great way to do that for young people is buying either a low-cost mutual fund or an ETF, an exchange-traded fund. It's a great way to get exposure to a lot of things. For this illustration, we don't really have much in front of us, so what we're going to do is we're going to just fill me up with a little bit of both.
There you go, man.
I'm getting my small cap exposure. I'm getting my large cap exposure. I'm covering my value stocks. I'm covering my growth stocks. A lot of foam on this one today. We're not going to worry about it. That's part of the volatility of the stock market.
There you go.
Great illustration. Great illustration. So, getting slightly more aggressive and potentially much more aggressive. We've gone from bonds, which are the wine. We've gone to stocks, which is the beer. Now we're going to talk about private and direct investing. So, the biggest asset classes that people tend to think about on this are private equity. So, hey, I buy stock in a non-publicly traded company. A lot of times that's a startup, something like that. A great example would be Tusk Media, us. We're putting out this Young Buck show. Maybe you say, you know what, I really like those guys. They're raising money. I'm going to give them $1,000. We're really small, so that'd probably be worth like 98% of our company. But maybe you do that and you say, hey, that's where I'm at. We're not paying a dividend. We're not publicly traded. We don't really have any assets other than the beer and wine that we're about to drink. But you own a stake of us. Now, if you really understand the media world, podcasting, YouTube channels, Tusk, what our vision is, our demographics, all of those kind of things, you could make a case for that being a good investment. Now, I'm not making that case, but you could make that case. Another common place you see this happen a lot is in real estate. Hey, I'm investing in this investment property. Maybe it's a home that you already own and you're looking to move and you say, you know what, I'm going to make this a rental property. Where you really get in trouble is with liquors that you don't understand. So we're stepping into the liquor, going for the hard stuff now. So you got stuff like tequila. Here's the thing, folks. You wouldn't be at a bar and see a half-consumed tequila shot sitting on the little tray and say, you know what, I'll finish that for a stranger. Similarly, you shouldn't jump into a private investment deal, whether it's real estate, private equity, you name it, without really understanding who's bringing you this thing. Know the people involved. Know what they're doing, how they're doing it, what's going to happen. Analyze your upside and your downside. With a shot of tequila, believe it or not, you got a pretty steep downside. Things could go really south, could get sick or worse. Your upside is relatively limited. Kind of the same goes for private investing. Now, you could have really, really great upside if you say, you know what, I trust this person, I know what they're doing, I know how it works, I understand the industry. If it's real estate, I understand that location. This is a great opportunity, legitimately a great opportunity, not just somebody pulling the wool over my eyes. You can make that work. But what I prefer, grab that bourbon right there.
Absolutely.
Is making sure you're finding those deals where you know everything. You don't want to be blindsided by a bad tequila shot at the bar. You don't want to be blindsided by not doing your diligence on private investing. So, I'm not really a tequila guy. So this works out perfect. I'm more of a bourbon guy. Like I said, I drink American. I know a lot about Michter's. I know that their 10-year bottle, single barrel, is pretty tough to find. I know that it's pretty expensive. I've had it before. I know it's going to be pretty reliable, and I know, you know what? There's a risk to hard alcohol. It's out there. But you know what? I trust this product. I've done my research. I've done my diligence. Cheers.
Cheers.
So, there you have it, folks. Water is your cash. Make sure you always have some. You're going to want a little bit of wine. It's nice for a dinner party. Also nice to have some fixed income or bonds in your portfolio. Bulk of your portfolio right now at this point, given the average net worth of a young person and their life expectancy and their earnings trajectory, the bulk of what you have should really be in the beer, which is going to be the equities. Make sure you have some large cap, stable stuff, paying dividends. Make sure you have some small cap stuff, get you a little growth in there. If you get an opportunity that really makes a lot of sense, look into direct investing. There's nothing wrong with that. And maybe the most common way is, employee stock options at a small company, things like that. There's nothing wrong with exploring those. And if you get that opportunity where you work, that should, if anything, be the company you know the best. You should know that company better than you know Apple or Microsoft. That doesn't mean it's not without its hair. You can still get a pretty nasty hangover or even some heartburn if you do it with some bad whiskey, but you know what's going on there.
Yeah, and real quick before we go, I do want to differentiate in two ways, I think, investing and drinking differentiate. First, you can invest before you're 21, right?
Oh, nice call.
Because no one drinks before they're 21.
Keeping us compliant.
That's
there.
right. And number two, these might be good one by one, but
Are we doing what I think we're doing?
they make a pretty bad cocktail. So that being said, thanks for watching, everybody. Cheers.
To the haters.
Ooh, dude.
That's a bad portfolio.
Real bad portfolio. Disgusting, even.
All right, everybody, last segment for today. This is called The Call Out. We're going to be doing this periodically, and what we're basically doing is calling out people, places, and things that are, well, flat out dumb. Things you should not do in your personal financial life. So, first subject ever is one that's near and dear to my heart because it involves football. Big football fan here. We're talking about Clinton Portis, former Miami and NFL running back. Not sure if you guys saw this story this week, but it was pretty insane. So Sports Illustrated, always great reporting, had this headline about Clinton Portis. Away from NFL spotlight, financial ruin drove Clinton Portis to the brink of murder. So, pretty dramatic. I was all in, obviously. Had to do with football, had to do with money. Let's do this same thing. So, if you don't know Clinton Portis, if you're not familiar with him, he was a beast. He was a running back. He played 3 years at the University of Miami. Last year he was there, ran for 1,200 yards, racked up 12 touchdowns, did really well. That was in 2001. Goes to the NFL Combine, which is where everybody tests you on all kinds of things, including your intelligence, ironically. He ran a 4.35 40-yard dash. That's incredibly fast, especially for a man that weighed almost 220 pounds. Now, as you might imagine, that led to a really successful NFL career. He was drafted in the second round by the Denver Broncos, played his first 2 years in Denver, racked up 1,500 yards in both of his first 2 seasons, which is pretty incredible. Next year, he gets traded to the Washington Redskins, only runs for 1,300 yards, follows that up with another 1,500-yard season. So pretty insane numbers right there. For context, 3 of his first 4 years, he ran for 1,500 or more yards. Over the last 4, the 4 most recent NFL seasons, only 3 players have done it, and none of them have done it more than once. So he was a really, really talented running back. Ended up playing 9 seasons in the NFL, which is pretty lengthy for a running back, seeing how much they get banged up and hit. He rushed for almost 10,000 yards, finished his career with more than 80 touchdowns. So really successful career, most notably for this, a money show. He made $43 million. So you may be sitting here and saying, how is a guy that good with a football in his hand, that bad with money? So bad that he ends up on the brink of murder, according to the headline. Well, that's a great question. Couple observations from the article. Things that he did that maybe you expect from these awful stories of athletes squandering fortunes. Number 1, he owned, and I quote, a lot of houses. A lot of houses. Not 1, not 2, not 3, a lot of houses. So he owned lots of houses. Not necessarily the most logical thing because he only had 1 body. So not really sure what he was doing with a lot of houses, but he owned a lot of them. Another NFL star, Santana Moss, owner of 11 cars himself. Santana Moss owns 11 cars and says, well, you know what? Know who's really crazy? Clinton Portis. That guy was bad with money. He was on another level, is what Santana Moss was quoted as saying. Different level spending coming from a guy that already has 11 cars himself. So, is this thing on? What happened? I'm so alarmed. But those weren't the only bad decisions he made. Who remembers Stratton Oakmont? Anybody remember that? Wolf of Wall Street firm. You guessed it. He gets tied up with a financial advisor that used to work at Stratton Oakmont. That Stratton Oakmont. Now, you might want to party with Jordan Belfort. You might want to live the Wolf of Wall Street lifestyle, at least for a little bit. But if you do a little bit of research, you can pretty quickly decide, you know what, I probably don't want to work with somebody that used to work at Stratton Oakmont. Nonetheless, he does it. This guy puts him in all kinds of typically not good investments. Investing in, private equity casino plays, borrowing money, supposedly taking money without Clinton Portis' permission to the tune of $3.1 million. Clinton Portis trusted the wrong guy. But guess what? It gets better. Only thing worse than trusting one Stratton Oakmont advisor is trusting two. He gets hooked up with another of them, and that guy continues to just take this money, take this money, take this money. Things go really south. What's interesting is how Clinton Portis kind of got suckered into working with these guys. The quote that he has is awesome. He says, they came impressive. The complication begins because you don't understand it. You don't know what they're saying, but you just get involved. So usually not a great rule of thumb to work with anybody in any field if you don't understand what they're doing. Definitely not a good thing to do when you have tons and tons and tons of money that people are trying to grab at. In 2015, Portis had to file for bankruptcy. He claims that he's got $1 million note that's payable to him from one of those Stratton Oakmont advisors. Again, not with Stratton Oakmont, but he used to be there. Also says that he's got up to $10 million in quote-unquote potential claims. But boy, this was a doozy of a bankruptcy filing. Among the things that he claimed as debts, $421,000 in domestic support owed to 4 different women, $500,000 that he owed to his own mother, $390,000 owed to the IRS. It's never a good thing to owe money to the IRS. It's an even worse thing to owe money to your mama. $287,000 owed to the MGM Grand Casino, $170,000 owed to another casino. He had to sell these lavish homes that he had in Virginia and in Florida. He had to sell his Miami condo at a below market price. And this isn't even the worst of it. Back in 2013, he found himself in a parked car, both in the morning and in the evening, on multiple occasions, sitting there with a gun, waiting to kill his former advisor. He has a great quote in there in which he says, no, I wasn't waiting to beat him up, I was waiting to kill him. So what's the point of all this? Obviously, I don't want to just get here and beat up on former NFL running backs, because that's a great way for me to get beat up. Rather, I want to take the lessons that we can learn from Clinton Portis and his squandered $43 million and figure out how to apply that in our lives as young people who are starting to earn a little bit of cash. So, first things first, WWKD. Important. That's 4 letters. Who will I kill for this deal? WWKD. If you're looking at an investment and you're saying, you know what? The upside's definitely there. But if this thing goes south, somebody's going to get murdered. And I'm going to do the murdering. Walk away. Not a great investment for you. Secondly, look into the people you are working with. Don't get blinded by how flashy they come off and how impressive they may seem. Look into them. We have this thing called the Google machine. You can get on a computer and use it, find out all kinds of stuff about all kinds of people, figure out what they do and how they do it. Know who you're working with. If you look up someone and they worked at Stratton Oakmont, maybe don't work with them. If you look up another person and they also worked at Stratton Oakmont, definitely don't work with them. Because again, 2 advisors in this case is worse than 1. Thirdly, know what your advisor is doing. This is really, really, really important. Talk to your advisor. Understand what they're doing, how they're doing it, how they're getting paid. Understand what powers they do and do not have. We work with clients all the time who sometimes are almost annoyed when we have to get them to sign paperwork like a wire transfer or sign for a new checkbook, something like that. But the reality is that's a good thing. You don't want me being able to blindly take money out of your account. That's not a good thing for anybody. So find out what they're doing, how they're doing it, and what they can do and what they can't do. Lastly, take some responsibility for yourself. If you add up the amount of money that these bad advisors swindled Clinton Portis out of, allegedly, if you add all that up, it's still just a fraction of what he actually earned. don't buy things you don't need. He owned homes all over the place. He owned many, many vehicles. He lived a very lavish lifestyle. He talks at one point in the article about how he grieved, and he grieved by flying to Europe and going on these large international vacations with multiple women at a time. That's a really great way to have 4 women suing you for unpaid child support. That's not a great way to save money. So, maybe hard to apply that if you're living a normal lifestyle of a young person and you're not an NFL All-Pro running back, but there's a lesson to be learned there, and that you should not buy things that you don't have to have. Don't waste money on the frivolous things. Don't waste money trying to live a social media lifestyle just so that you look cool for your friends. Make good decisions so that you don't have to kill anybody over your finances. Thanks for being here. This is the first episode. Make sure to stick around for the credits and the disclosures. We'll be back next week.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.